Hi, and welcome to the Choose FI Foundation's Educational Speaker Series, where we take topics from the Choose FI Foundation's pre-K through 12 financial literacy curriculum and break it down with expert speakers in the area to bring a little bit more information and ideas to the topic. Hope you enjoy it.
Hey everyone, this is Rob Phelan, and welcome to your questions about credit answered. So we've had a series of 5 videos all to do with credit, different types of loans, borrowing, and repaying those loans. And I know you guys had a lot of questions, so I want to tackle those before we move on to our next section. So these are going to come from different listeners. If it's a question you had, awesome, you just got it answered. If you have any other questions after this, please send them in. I'll try and get them answered in a follow-up video. All right, so first one today comes from Connor. How much can you borrow from a bank? So going to that first interview with Stacey Hart where we were talking about banks, credit, and that sort of thing, the amount you can borrow is dictated by the bank based on what they feel comfortable letting you borrow. So like what's the risk involved and what's the purpose of the money sometimes. So for example, a lot of times you won't be allowed to borrow like $800,000 to buy a $200,000 house because the collateral of the house is not worth what you borrowed. So there's going to be caps on that based on what they think you can repay and if there's any collateral on the loan. Sierra asks, how are interest rates calculated? So there is a national interest rate, so that's dictated by the Federal Reserve. So you can sometimes hear the Fed being thrown out in politics as having raised or lowered interest rates. They do that to try and control the amount of cash flow in an economy. So by making interest rates lower, they're trying to encourage people to borrow money, bring more cash into the economy, and stimulate growth. When interest rates get higher, they're usually saying, okay, the economy's pretty good. We're going to try and recoup some of this money in interest rates and start paying down debts to kind of reduce the amount of debt in the economy. So it goes in cycles. But basically, most banks, mortgage lenders, auto loan providers will take, they're essentially borrowing money from the federal government at that lowest interest rate, and they're tacking on a little bit to that as well. So the lowest they can go usually is the federal rate, but those are typically going to be a little bit higher than that depending on the type of loan and who's giving it to you. Shelby asks, do you need a credit score for buying a car? Yes, you are getting an auto loan. They will look at your credit score, but you will notice like on the side of the road, you will see these little signs saying, buy your car here, good, bad, no credit score, doesn't matter. Run from those if possible, because you should not be going to one of these lenders. Basically, the interest rate will be insane because you don't have a good credit score. So they're basically taking a shot that they can get a lot of money back on interest rates to you in exchange for the risk of loaning money to someone who doesn't have a good credit score. Mason asks, does income impact credit score? Not directly, but it will impact your debt to income ratio. So the amount of debt you have in comparison to your income. So when you're getting a mortgage, that's something that they will look at. So basically, what's your ability to repay this loan compared to how much debt you already have? So better income will increase your chances of getting a lower interest rate or getting a loan. Okay, Justice asked, how do you check your credit score? It's a great question. Where do you have this credit score? Where do you find it? First place you can look is if you have a credit card, or sometimes a bank will offer this. There's a free credit check kind of perk that comes with the account. So I have a Capital One card, a Chase card. Both of those offer free credit check. You can also go to a website like creditkarma.com and you can check your credit score there. It should be free. You should never pay to check your credit score. Your credit report, on the other hand, comes from one of the 3 credit reporting agencies. So that's Experian, TransUnion, and Equifax. You are allowed to check your credit report. So this is the detailed report of all borrowing and repaying that you have done over your lifetime, basically. You can check each of those once per year for free. So what I would recommend you do is divide the year into thirds. Every 4 months, check one of the credit reporting bureaus. So say like in April, you're going to check Equifax. In August, you're going to check TransUnion. And then in whatever the last month is, January, you're going to check Experian. All right, moving on. We've got a couple of people asked, how old do you have to be able to get a credit card? If you're on your own, 18. So if you just want to get your own credit card, 18 is the lowest you can be. If you are going to be a authorized user on a parent's credit card, I don't believe there's any minimum age. As far as I can find, I could put my 8-month-old as an authorized user on my credit card if I wanted. So remember, listen back to the episode with Brad on credit cards to see what the potential risks are for being an authorized user. But it is a good question. Yes, you can get one at 18. Sierra, Tyler, Megan all ask, what is the best time to get a credit card and start building credit? Okay, so 2 different questions. Your best time to get a credit card is going to be after 18, when you feel like you are responsible enough, you're mature enough to be able to handle having a credit card. That's the best time. If you're not there yet, don't get a credit card. I would look at your track record for repaying any other debts you've had along the way. So maybe money you borrowed from friends, parents, and so on. If you don't have a job yet, unless you have income of some sort, not a good time to get a credit card. So you want to have the ability to repay your credit card before you consider getting one. So like if you're getting like an allowance from parents every month or part of a student loan, maybe it was covering living expenses, you could get a credit card and say, okay, I'm going to have the income to pay off this card. That's fine to do. And then start building credit as soon as possible. So, I would say like maybe look at getting a secure credit card as soon as you turn 18. That way the risk is lower for you. You can learn, you can have bumps along the way. It's not going to really hurt you too much. And then once you feel you've demonstrated the ability to manage credit well, every, I think 6 months, you can apply to have your credit limit increased. So you call up the credit card company and you say, hey, I've been repaying on time. Can you increase my limit, please? All right. Sierra asks, what is the best type of mortgage to have? So kind of moving into the mortgage questions now. So best type of mortgage, in general, there's the conventional, the FHA, the VA, and the USDA. Most of you guys are going to be going for a conventional or FHA because you're not military, so you don't qualify for the other 2. I would say if you have a good credit score and money to put down, a conventional loan is going to be the better deal for you. If you don't have money to put down and you have a poor credit score, question mark on whether you should be buying a home or not, but an FHA loan is one you will be able to qualify for and be able to use. Remember, the downside for that was that you will have mortgage insurance on that for the entire life of the loan, and you may have a higher interest rate the less money you put down. In terms of fixed rate or variable rate, fixed is typically the one you want to go for. So variable will often start low, and then after like a year or 2, it'll start tracking the markets, whether interest rates are going up or down. Problem is, what happens when the interest rate goes up and your mortgage rate increases, but you haven't budgeted for that, and you already budgeted all your money, so now you're trying to kind of come up with extra money, or you have to lose category somewhere else. It can be a really tough time if that happens, especially like now interest rates are so low. So if you get a variable rate mortgage, the likelihood is that interest rates are going to go up. There's not really much room for them to go down, so they're probably going to go up. A fixed rate loan, on the other hand, it's fixed. You got it. You know what you're going to pay. It's going to stay the same for the life of the loan. The only thing that will change on your mortgage is your property tax and mortgage insurance. So if those rates go up, the amount you pay per month could go up a little bit. But the borrowed principal and interest will stay fixed. Nicole asks, has there been times that people will get completely screwed over for being in a variable rate mortgage over a fixed rate? And we kind of just talked about that. So like you got into a more loan at a low payment, you're like, okay, I can handle this. And then it starts going up and it starts squeezing your budget, and say like you lose a job or your income gets slashed a little bit. And now it's hitting you on both sides. So yeah, it's a risky play. A lot of people who get variable rate mortgages are people who flip houses. So they're buying a house, they're holding on to it for a couple of months while they fix it up, and they're selling it. So having a lower interest rate, even if it's variable, doesn't really matter because they're not holding on to it long enough to really feel that. Okay, Rachel asks, will checking my credit report hurt my credit score? If you do the 3 credit bureaus, no, it does not. It doesn't count as a hard hit on your credit score. It's free to do as long as you're doing it once per credit reporting bureau per year. Other than that, you're paying a fee, but it still doesn't hurt your credit score or your credit report. Emily asks, what happens if you don't pay back a loan? It's a great question. I don't pay it back. Well, what's going to happen? It depends on who the loan is with and a lot of times how much it's worth. So let's talk about like your mortgage. If you don't pay a mortgage payment, your mortgage provider will send you a letter. They'll say, hey, you missed payment. You need to, start paying. Like we're going to start dinging you for this. So there might be a fee tacked onto that. There might be extra interest put onto it. And if you still continue not to pay, they will continue to look for their money. And at some point, they will send you to collections. So sending you to collections means that they are basically giving up on this debt. They're saying, all right, we cannot get you to pay. We're going to pay somebody else basically to chase you down for this debt. And either they sell the debt to the collector. So the collector will say, okay, we'll say, Emily, for the example, Emily, you owe $100,000 on your medical bill. So medical bill is a good example for this. And the hospital's like, all right, we're not getting this $100,000 from Emily. This collections company is offering us $50,000 in exchange for the loan. So they will take over loan. They will take over harassing you in the hopes of getting the 100,000 back, and the hospital gets 50,000 because 50,000 is better than nothing. If it's a mortgage, it can get to the point where it goes to court, and because the house is collateral, basically they foreclose the house. So they force the selling of it. They take their money back. If there's anything left over, you get it, but essentially you're out of luck. Same with a car. Like they can repossess the car, take what it's worth out of it, and then that's it. If you are upside down on the loan, so that means that the asset, the house or the car, is worth less than what you owe on it, they can go chase you down or sue you for the remaining amount. Megan asks, how long does it take to rebuild credit if it gets low? It depends on what you did. So if you just missed a payment, your credit score might drop by 15 points. It might take you 3 months or 4 months for it to come back up. If you're if you're repeatedly not paying something, or you go to collections, or say you go bankrupt, like a bankruptcy takes, I think, 10 years to come off of your credit report. So it does come off eventually, but it's a long time, and it's very hard to borrow any money once you've declared bankruptcy. If you are continuing to fail to pay something, your credit score is going to keep dropping. It's going to keep dropping. And then when you finally get your act together and start paying it off, it will come up, but it will come up slowly. A couple of people asked, how often should a credit card be used as a student or adult? So what's the best thing you can use credit for? How often? If you're just looking to build credit and you're not necessarily like really spending a lot of money, like once per month is fine. Putting the gas in your car, using your credit card, and then paying it off every month, perfectly fine way to build credit. Best thing you can use credit for, I mean, there's nothing really that's awesome to use credit for. Make sure it's something that you're not going to get charged extra for paying with a credit card. So for example, I cannot pay my water bill using a credit card without them adding on an extra percentage. So remember, when you use a credit card, the vendor, so the person selling you the service or the product, is paying a small part of the sale to the credit card company. So what they might choose to do is say, okay, well, if you pay the credit card, we're going to charge you a little bit extra to cover that. So just, there's no point in using credit in those situations, because usually the rewards you get are less than the fee that the company is charging. Megan asks, can you cancel a credit card? Yes. You have to zero out the balance, so you have to pay it off, and then you can call a credit card company up and say, I would like to cancel this credit card. Perfectly fine to do. The number's on the back of the card usually. Kayla, Cole, and Madison, if you use more than one credit card, is that bad or good? And if you say you have 2 credit cards and you don't use one of them, will it impact your credit score? Or if you're using multiple credit cards on a regular basis, doesn't matter. It does not matter how many credit cards you have. You want to make sure that it's a manageable amount. So the more credit cards you have, the more accounts you have to keep track of. So if you're spending money on 10 different credit cards, you have 10 different statements coming, and you have to make sure all 10 are paid off on time. It's a lot. The more credit cards you have, the higher your credit limit. So the total amount of money you can borrow. So if you have 10 credit cards or 5 credit cards with a $2,000 limit on each, that's $10,000 in available credit. So that helps your credit score because you have more available credit, and your credit utilization goes down because you have more credit compared to what you're borrowing. But you do have that problem of multiple credit cards. The other question, like if you have multiple credit cards, so say I have 4 credit cards, I really only spend on one because it has the best rewards. Does that hurt me in any way? No. Capital One will probably email me once a year to say, we want you to, like, we're going to close your account because you're not using it unless you start using your card. So at that point, I'll usually go buy gas on my card and I'm good for another year. So just be aware of that, you know, if the card's not being used, it may get shut down, but usually get a warning beforehand. Jake asks, if you have the money, you're already spending on a card, then why not just use a debit card? So what's the difference between a credit and debit card, and does a debit card count towards credit score? Well, you kind of hit it with that third point. A debit card will not count towards your credit score because you're not borrowing money, you're using your own money. So why do you use a credit card? You're using a credit card either for the rewards, so there is an actual value to using it. So in my case, I get like 1.5% cash back every time I spend it. So every purchase I get is 1.5% cheaper than it would have been full price because I'm getting some of the money back. If you are building your credit score, so you're building credit history, you're using a credit card not because you need to borrow the money, but because you want to demonstrate that you have the ability to borrow money and repay it faithfully. So when it comes to things like a mortgage, or if you say need to take a loan to buy a car, you've got that credit score to back you up, and it makes the cost of borrowing money cheaper later on. Great question. Seth asked, when should you stop using credit? And there was kind of 2 parts to this. One was, you know, when do you stop? And say you don't feel like you ever need to borrow money anymore. You're rich, you're at financial independence. Can you just stop using credit? And there's a couple of things you can do. You can freeze your credit. So you can say, okay, I'm not planning to borrow any more money, so I want to freeze my credit score where it's at. There's usually a limited amount of time for how long you can do that for. If you just stop using credit, you'll start noticing that your credit utilization history will go down. Your credit score will eventually start dropping. And if you just like cold turkey stop using credit for a long enough period of time, you will eventually just go back to having no credit score. Now, I'm not sure exactly what the time period on that is. My gut's telling me like it's about 5 to 10 years, somewhere in there. Cole asks, if you apply for a credit card and it gets approved, can you still back out of getting one? So usually if you've gone through the process of applying and you've gotten approved, you've already submitted the application, they will say, yes, it's on the way. All you have to do is call them up and say, I actually changed my mind. I don't want this credit card anymore. Either you will have to mail it back to them or you just cut it up when you get it and they close the account. No problem. Multiple people ask, how does the cost of a mortgage compare to the price of a house? So the mortgage is calculated based on the amount you have to borrow. And the amount you have to borrow is the price of the house minus your down payment. So whatever you're paying out of your pocket, you're not borrowing that. So you got the price of the house minus your down payment. You've got the closing costs, and you've got any sort of other costs that maybe come up in there that you need to borrow for. So like if you have to negotiate up on the house or something like that would be something you'd have to borrow for. So it's usually a very kind of finite number. You can't just infinitely borrow because, again, price of the house is the value of the house is really important in terms of how much you can borrow. Sierra asked, what's the average down payment on a house? It ranges from 0 to 100%. Most people are typically looking to put down somewhere between 15 and 20%. If you are buying a second home or an investment property, you have to have 25% down minimum. Multiple people, why do mortgage companies sell loans? Now, this was a question I had. So if you remember my story with Gabe, I got a loan for my house, and within a week, it had been sold to another mortgage company. And I remember being really confused by that. I was like, wait, I just built this relationship with this loan provider, and as soon as we closed the deal, it got sold. So I was no longer dealing with the mortgage company that I had spent all this time like talking to them, negotiating, building a relationship, which was kind of an odd one. So why do they do it? It's a risk and reward play. So you imagine I borrowed $220,000. So I borrowed $220,000. That mortgage company basically has given me $220,000. So their balance is down $220,000, and they're slowly going to recoup it. So what they can do is they can say, all right, well, if we held this loan for the entire 30 years, we would get back our 220,000 plus a crap ton of interest. So like they would be due to get back over, I think, 400,000 by the time I was done paying off my mortgage. So what they might do is they might say, okay, well, we kind of want the money now and we can't get it back because it's a 30-year loan. So what we do is we find another company who's willing to buy the loan. So another company might come in and say, all right, like Mr. Phelan borrowed 220,000. If we held it for the entire amount of time, we would get back about 400,000. We'll offer you $250,000 for that loan. So my first mortgage company makes a quick $30,000, and this new company takes over my loan, knowing that they're still going to get about 400,000 back. So they're still making a very healthy profit on my loan if they can wait out the total term. And actually, my loan has been sold again since then. So somebody else has probably come in, bought the loan, and paid a little bit more than what it was worth, and so on and so on. Usually, if you're showing that you are a very good person at repaying your loan, like you're paying on time, your loan becomes more valuable. So people might be willing to pay a little bit more for it because they know they're basically guaranteed to get that full payment. So the better you are at repaying loans, probably the more likely your loan is to get bought or sold. Can't confirm that, but that would be how I would guess it works. Kind of the same with bonds. Megan Sierra, when is the best time to buy a house? Is it best to wait for a stable job? And is there a best time of year? So the best time to buy a house, we're going to do a video really soon on what's called house hacking. So that is how you get your home to start generating money for you instead of you just paying for it. And I think in that episode, you'll probably get a better answer because we'll talk about like the earliest and what you can do to get your house to make money for you. If we're just talking about buying a home and it's just for you, the best time is going to be probably when you have a full-time job and you're happy with that full-time job. Because if you're not happy with it, you could move, like you could change jobs. And then if you're changing jobs and it's in a different location, well, now your commute gets really big, or you have to sell the house and move somewhere new, which comes to all those closing costs again, which can end up coming out of your pocket. So you kind of want to be settled down in your life a little bit before you consider buying a house. So I would say get out of college, or get out of college, find a job, and kind of give yourself a little bit of time to see, is this job really what I want? Am I in the area I want to be? So like, have you moved geographically from where you grew up? Do you want to move back there? Are you still near where you went to college? Are you in some random part of the country? Are there friends, family nearby? Like all those things. And then kind of figuring out where you want to be based before you buy a house. I would actually recommend renting in the area you want to buy for a couple months, just to kind of see like, do I like it here? Is the crime rate low? Does it feel safe? How's my driving distance? Is the commute okay? Or is there a ton of traffic? Like it may be short, but there's a ton of traffic. Whatever it is, you kind of test out a neighborhood first. On the flip side, there are things like, well, you could buy a house in the college town you're going to stay in to reduce the cost of going to college. And then when you're done, you would either sell it or you would keep it and rent out to college students for years to come. So it turns into an investment property. That one would probably be later in the house hacking or real estate investing videos, but it could be done. Best to wait for a stable job? Yes. And you're probably not going to get a loan unless you have a stable job. They're looking for employment history. And what you will find is that people who are employed are more likely to get a mortgage versus people who are self-employed, because self-employed, you have to show that you are working for yourself, so that you've created a stable business that is going to be able to pay for this mortgage for years to come. So usually you'll need, again, about 2 years of steady income coming in. So if you're starting your own business, the first 2 years, like you may not make as much profit as you would normally do. So it may take a couple of years to build up to where you're saying, oh yeah, I can support a mortgage. Best time of year? There's mortgages are typically divided into a buyer's market and a seller's market. In a buyer's market, it means that it's advantage to the buyer. There are a lot of houses for sale and there aren't as many people looking to buy. In a seller's market, it's the opposite. There are a ton of buyers out there and not a lot of houses on the market. So that affects the price. In a buyer's market, you might be able to get a house for cheaper. In a seller's market, you may have to pay more because there's multiple people bidding on the same house, more buyers versus sellers. Typically, best time of year, winter, because less people are willing to move in winter. Summer is probably the peak because people try and move before a new school year starts. So between June to August is probably the peak time for people to move. And then getting into spring and so on, like people are thinking about it. So winter is, I would say, the best time if you're looking for properties. But then people aren't selling in winter as much either. So it's supply and demand. There'll be less competition in winter, but there may be less properties available too. Aaron asks, can you use a mortgage to build your own home? Awesome question. Answer is no. You have to get a home building loan. So it's a special type of loan where you will have to negotiate with a bank to say, like, this is the house I want to build. Here are the plans. Here's the site that I want to use. And this is what the home should be valued at by the time I'm done. And this is what it should cost me to make it. You then get a loan based on that. And the bank will have milestones. So like when you get to a certain milestone in building, you can borrow the next part of your building loan. So they don't just give you the lump sum all in one go and say, have at it. When the house is complete, usually what happens is the construction loan you got is going to turn into a mortgage. So either you go get a mortgage to pay off the construction loan and turn it into a mortgage, or the company that you got the construction loan from will just turn it into a mortgage for you. So you just need to have a completed house that they can use as a collateral for a mortgage. Same with renovations. Renovations are their own type of loan, or if you're buying like a fixer-upper house, like a lot of times you can't include that in the mortgage because the house is currently valued at that lower rate. So you can only borrow up to the value of the house. Otherwise, the bank is taking extra risk. So usually you have to get a different type of loan for doing renovations. Jacob asks, are there specific auto loan? Why are there specific auto loans, mortgages, and other types of loans? Like, why are there these different industries for them? The basic answer is there's different regulations, there's different rules on how money can be lent out for these different things. So there's different criteria that mortgage providers have to look at versus an auto loan for deciding whether to lend you money or not. And then you want specific people in those areas who know the industry well. So you imagine like if you were giving out a loan, and it could be for anything, you would have to know a lot about a lot of different types of industries to be able to make an informed decision about whether you're going to give that loan to somebody. So by dividing up the industries, it makes it more likely that you are going to get somebody, giving you a loan that knows about that industry and can give you a better deal on it and will be able to evaluate the loan better. Hayden asks, would it be better to buy a small home, pay it off and pay it with cash, or buy a house with credit and pay it off over time? So it's a really great question, and it's kind of the same thing that applies with cars, that an awesome strategy is to save up. So if you could save up like $50,000, go buy a $50,000 house. While you're living in it, save more, like keep saving. So save another $50,000. You sell your first $50,000 house, maybe it's worth 60 now, so you get 60,000 back, plus your 50,000 you saved up. So now you can move into a $110,000 house. And you do that, you save, and eventually you can maybe trade up into a $300,000 house. So like you can trade up in your house as you go, and you never have a mortgage at any point. It's an awesome strategy. I recommend you do it with your car for sure. So start small, save $1,000, get a $1,000 car, save up, buy a $2,000 car and sell the $1,000 car again. And you just keep trading up. And then eventually you have nice cars and you don't ever have a car payment, and you just keep saving for the next car. Sammy asks, how do I get a rough estimate of all the fees that come with buying a house, all those closing costs? The short answer is you go to a website like Bankrate, or you go to a website like NerdWallet, and they will have total cost of like house buying calculators. So like Google it, you will find it. You can say closing cost calculator, and NerdWallet, Bankrate are two sites I would recommend you look at for those. It'll be based on the price of the home, the area you live in, and so on. Luke asks, if you have a fixed rate mortgage, are there any impacts if your credit score drops afterwards? So great question. You've done a great job building your credit. You got the mortgage, you've closed in the house, so it's yours, you got the keys, you're living in there, and then suddenly say like you stop or you miss a payment on your credit card and your credit score drops, or you change jobs, or whatever it is, the things that your mortgage provider is telling you, please do not do any of these things beforehand because we don't want your credit score to change. After you got your mortgage, if it changes, it doesn't matter. The only time it matters is if you're planning to borrow more money in the future. So going back to that last question of like trading up in houses, so say you get a starter home, so a lower cost home, you have a mortgage on it, you're paying off that mortgage and you're saving for the next home. If your credit score drops in the meantime, your next home, the mortgage price will be affected on that. Or if you go to get a car loan or whatever, hopefully, you will get to a point where you don't need to borrow money anymore. So like say you don't have a car loan, you've paid off your student loans and you have your mortgage and you don't really see any other borrowing in your future. So like for me, like I don't see myself needing my credit score for another like 7 years. I could afford a little drop, but I wouldn't want it. I want to keep building and getting higher and higher so that, say, I could do something like refinance my mortgage. That's basically where you take out a new loan, pay off the old one, and the new loan is at a better interest rate. So I could refinance at some point with a better credit score to get a better rate. Ty asked, what happens if your estimations are off and you can't repay your mortgage? It's kind of what we talked about before. What happens if you don't pay off your debt? You better make sure that you are doing your homework in terms of what you can afford, because if you can't, either you're going to lose your house, you're going to lose your car, you're going to get sued for the balance. So if this is related to student loans, remember that's based on the collateral is essentially your future income. You can have your wages garnished. So your future income will just constantly be subtracted until that loan is paid off. Justice asks, so we're kind of into college questions at the moment. Why is college getting more expensive? Because people are willing to pay it. Supply and demand, people are still willing to pay this higher amount for college, so colleges are continuing to charge more. And the problem is that student loans kind of don't have that ceiling on them, so people are just borrowing more to pay for college, and it's becoming this sort of vicious cycle. I think we might see a little bit of change in that after this pandemic is over, because we'll see colleges kind of transitioning to more digital environments, or people realizing, oh, I don't need to go to the most expensive college in the world because a community college / 4-year college degree is almost the exact same thing. And after about 3 years, nobody cares, what college you got your degree from. It's all about what you can do and what your experience is like at that point. Courtney Lexi asked, why do people take so long to pay off their student loans? Remember, the average is 21.1 years or 23 years, according to Rob Phelan. And can I pay them off early? So the term on a student loan is about 21 years, and people can defer their student loans. So say you borrow the money, you go through your 4 years of college. A lot of times your student loans can be deferred. So that means you don't pay anything on them for 6 months after you graduate. And this seems like a great deal. You're like, cool, don't have to pay any money. But really what's happening is your student loans are accumulating interest all that time. So the longer people wait to start paying it off, the more they're going to have to pay, and so on. Yes, you can pay them off early. You can pay them off whenever you have the money to do so. I would recommend, trying to get rid of those loans as maybe not as fast as possible. We'll talk about that in a second when we get a little bit further into the loan stuff. But certainly, like, you don't need to keep your student loans around for the rest of your life. Like, you can pay them off as soon as you're able to do so. They don't have to take 21 years. I paid my student loans off in 4 years. So it's something you can do. Multiple people asked, is a student loan worth it? And it really depends on how much and the degree you're getting out of it. So if you are getting a 4-year degree from a private school for a job that's not going to pay you a lot, and I'll use teaching here as an example. If you go to the private school down the road and pay $40,000 a year for an education degree, you're going to come out of that with a bachelor's of in education in whatever subject and $160,000 in debt, and you're only going to make about $45,000 to $50,000 per year in a salary. So like the numbers just aren't making sense. You've paid way too much for the salary you're going to get. Same thing, like you can get a degree in like philosophy, and what necessarily you're going to do with that degree. So make sure that the degree you're getting is something that has usable skills in it, or it's a qualification that will land you a job. So, and the job has to pay enough to make it worth getting that qualification. Otherwise, it's not worth it. Go do something else. So yes, follow your passions, follow your dreams, but make sure that they are not going to cripple you financially along the way. You can always go to a cheaper college. You can go to community college if your dream is something that is not a high-paying job. Just find a way to achieve those qualifications cheaper. This is a really interesting question from Jacob. I know that there are companies that will pay for you to get your master's while you're working for them. Are there any that will just pay off your student loans? So typically when you're working for somebody already, no, it's not something that's going to happen. But if you are looking to change jobs or start a new job, this can be a little negotiating chip that you bring to the table. So you could say, all right, yes, I will come work for you. And as a signing bonus, I would like you to pay off my student loans. Or as Jacob mentioned, like you can find companies that will hire you and say, you want to do further education, we'll pay for it. No problem. Like we will invest in you because investing in you is going to make you a better employee. You'll make you more productive. You'll make more money for us in the long term. And it might make you more likely to stay as well. Like the military is a prime example of this, where you go into the military, you get your college education paid for, and in return, you have to give X number of years of service. So, they're getting something out of it. You're getting something out of it. And then that relationship could carry on longer if you chose. So I would say, ask, like go find a job and say, hey, I've got these student loans. I would really love to come work for you. I'm an awesome candidate. You really want me. Are you willing to pay off my student loans to get me to come work for you? So basically, can you give me a signing bonus of whatever my student loans are? Let's pay these things off. And yeah, I'm going to come work for you and I'll commit to working for you for 5 years or whatever the negotiating amount is, and see if they take it. So sometimes like they will take the security of you being there for a longer period of time in exchange for a more upfront fee like that. So ask, see what happens. Sierra asks, why does the debt snowball take longer than the debt avalanche? Debt snowball is not the most mathematically efficient way of paying it off. So if you do debt snowball, you're doing smallest debt to biggest debt, and you're just paying them off in a row. Avalanche, highest interest rate to lowest interest rate. So the highest interest rate is the one that's costing you the most. If that's not your smallest debt, you're just going to pay more interest during the time that you're doing the debt snowball. So it will take you a little bit longer to get there just because the debt is getting higher at a faster rate. So versus the debt avalanche, if you're hitting the highest interest rate first, technically that's the most expensive one. So it should move faster. Jacob asks, what debts are considered the most important to pay off? So this is a really great question. It comes up in the financial independence community a lot. You've got, say, a mortgage, you got student loans, you got credit card debt, and maybe you got like some medical bills or something like a personal loan like that. You look at the interest rate, and this is going to be very personal to you as well. So if you're the kind of person who's like, I don't want any debt, get rid of it, then you pay them all off. If you're like, okay, what do I need to pay off versus what do I don't to kind of get in a better financial situation? Typically, you draw a line in the sand with the interest rate. So if the interest rate is less than what you can make in like a broad-based index fund being invested, which is about 8% per year. So on average, the market returns about 8%. So if your loan is less than that, technically you will be better off, mathematically you'll be better off paying money into an investment account, so like your retirement account, letting it grow, and then just paying the minimums on your debt because the spread is going to be more towards the investment. If your debt is a higher interest rate than 8%, you should be paying it down. And I would say even 6% is roughly where that line in the sand should be, because you never know if the market's going to actually return 8. So in my example, your credit card would definitely be on the to be paid list. Like get rid of that thing because you're talking probably close to 20% interest. Medical debt can have a higher interest rate as well. Personal loans, depends on where you got the loan from. If you have like a payday loan, so like that's basically where you're borrowing from next month's check, and very high interest rate as well. Get rid of that. Please don't do payday loans, guys. Whatever you do, try to avoid them. And if you're talking like student loans, your interest rate could be down like around 5% or 4%. A mortgage, currently interest rates are down in the 3% range. Mine's 4.65. So I'm not paying extra on my mortgage. I'm not trying to get rid of it any faster right now because I am focusing on investing and growing my wealth. So if I can put money into my IRA, my 403B, and it grows at about 8%. Last year it was 30%. This year it's going to be a little bit lower because stock markets have really tanked. So if I can get that average 8%, I'm going to make more money, or it's going to be mathematically better for me to invest than pay off my debt. But it's, again, a personal thing. Like if you just don't like having debt, get rid of it. Like for me, I didn't like having my student loans. I wanted them gone. I got rid of them. So me and my wife decided we were going to get rid of all debt except for our mortgage, and we paid that thing down before we started really investing seriously. So it's up to you. And Lindsay asks, how would our generation, or how do you convince somebody who is spending money on subscriptions to basically stop? So they're addicted to spending money on on wants, and you want to try and convince them that they don't. It's very hard to convince somebody who doesn't want to change that they need to change. So I kind of approach that the same way when I teach personal finance, especially to a high school generation. A lot of you guys often don't realize that you need to start looking at your money and your finances because that need hasn't popped up yet. So a lot of times what you have to do is try and show, like, this is what's happening right now. Like, if you are spending all this money on this stuff, you're not investing in growing your wealth. So you're going to not have any money when you get to a later time in life, when maybe you want to have some more fun, you don't really want to work anymore. Or, you keep piling up this debt, like eventually, like, they're going to start calling for you to pay it off. And if you can't do it, you're going to get in a lot of trouble. Credit score is going to drop. You're going to find life to get a lot tougher. So sharing a lot of the knowledge you've acquired during this course is going to be a way to do that. If you're just trying to get them to identify things they need and want, ask them, can you survive without this? And during this pandemic, a lot of people are realizing, there's a lot of things I was paying for that I don't necessarily need. Gym memberships, prime example. Do I need the gym, or could I really work out at home and get the benefits, the exact same? Like for me, like, I'm doing free workouts on YouTube. I don't need a gym. Do you need all of the TV subscriptions? What are you watching the most? Can you just keep one at a time? Like, you can cancel something like Netflix. They'll let you back in. So you can say, all right, I'm not watching anything on Netflix right now. Let's cancel that. Maybe I'll pick up Disney Plus for a couple of months, binge the things I want to see on Disney Plus. And then when I'm done with it, cancel it. And then maybe take Netflix back when you feel like it. Like, you don't have to keep all of these things going at once. Like, you can use one at a time, drop it, and then pick it up as you want. For other stuff, like asking, like, do you really need it? Going through an exercise, like, what are the top 10 things you value the most? And then looking at what you're spending and seeing, like, do they match up with the things you value the most? If they don't, can you get rid of it? Do you really need it? You don't seem to care about it that much. Ditch it. Seth asks, can you combine your debt into a single form of payment? So take all of your debts and just put it into one debt and pay that one debt. This is essentially like called debt consolidation or refinancing. Basically, you're going to borrow one lump of money, pay off all the other debts, and then just repay on that one debt. If you are getting serious about paying off debt, this could be a good thing to do. So say, like, you got a credit card debt at 20%. If you can get a bank to give you a personal loan at 5%, 10%, that's great, because then you could just borrow at 5%, pay off that credit card, get rid of it, and then start paying back a loan at 5%. The problem is, like, if you borrow money to pay off all your other debts, but then you don't get serious about paying back debt, like, you just keep borrowing money, you're just going to end up in a worse spot than you were in the first place. And what a lot of people do is they'll borrow money, they'll pay off the credit card, start paying down the other debt, but then they'll start spending on the credit card again, so it gets even worse. So be careful about that. Yeah, it's not the best idea in the world unless you're really serious about it. Jacob asked, does the interest rate always go off the borrowed amount, or does the interest rate go off the balance you owe? Great question. Most loans, so like if they're an installment loan, such as a car loan, student loan, auto loan, what happens in your payment is a percentage of it goes towards your balance, or your principal, what you borrowed, and a percentage goes towards the interest. Every month, what's remaining on the balance, so the balance of the loan, the interest rate is applied to. So every month you should be lowering that balance down. So interest is applied. The amount of interest you're paying should be a little bit less every month. So if you're making the same payment every month, a greater percentage of it will start going towards that principal amount, the amount you borrowed, and a smaller percentage towards the interest rate because the total balance of the loan is getting lower. Good question. And Andrea asks, whose responsibility is it to pay your debts when you die? Does this fall on a spouse, kids, siblings, parents, etc.? So if you pass away, your debt doesn't go to anybody else unless you are married. So when you're married, you are legally responsible for each other's debts. Nobody else is, unless there's a couple other circumstances coming up. So you die, you have an estate. So this is all the things you own. And usually you have a will left behind that says, this is what I want to happen with my estate. If you still owe money, the people you owe money to, the creditors, are entitled to get their money back first. So say like you die and you had a mortgage on a house. Well, the bank is entitled to look at how much money you had in all your accounts and take their share out first. And if you don't have it, the house has to be sold. The bank gets paid back what they are owed, and then what's left goes into the estate and then gets divvied up as intended. So the exception to that is if you're a spouse. If you're married, you're legally responsible for the other person's debt. So say like I have student loans, I die, my wife would have been responsible for paying my student loans or a car loan or whatever. The only other time that someone is responsible for debt is if they are a co-signer. So if you have a co-signer on your student loans, so like your parents co-sign on some private student loans for you, or on a car or on a mortgage, and say you pass away before they do. If they are a co-signer on the loan, they're responsible for making sure the loan gets paid off. So it would fall onto them. So be very careful again with this idea of being a co-signer on someone's debt. Same thing like being an authorized user on a credit card. You're an authorized user on a credit card, parent dies, but they had a debt on the credit card. It's now your job to pay it off because you're a user on that card as well. Okay, that was a lot of questions, guys. Great questions. If you have any more, feel free to send me an email with them, rob@choosify.com, and I'll try and do a follow-up video again very soon with any other questions being answered. But love it. I hope I answered some of your questions today.